Hello, everybody. We're back at it again. And in today's small business segment, I'd like to talk about business charitable contributions. And the reason I bring this topic up is that in doing my business, I do bookkeeping, payroll, and taxes for smaller and medium-sized businesses. So I kind of see the whole picture as far as when people start businesses to when people prepare taxes and when they start over and do the same thing over and over again. And one of the common mistakes that I see small business owners do is charitable contributions. Now, don't get me wrong. I mean, charitable contributions are a good thing. Helping people out, kind of, making things run more efficiently. But but and I think when we give money, that's kind of all we think about, and that's certainly a good thing. But also, what I would try to get people to get knowledgeable about is things from their end. Are they doing things efficiently? Are they maximizing their deductions? And it really all depends whether you give money from your small business or your personal. That really kind of gets you the most deduction. And so I'd like to talk about those things. So one of the first things that people do in small businesses is that they just tend to give cash from their business, which is definitely a good thing. But there's certain parameters that you need to kind of keep in line as far as in giving it from the business. One of those is when you give cash, is that it's limited to 10% of your taxable income. So and most people don't exceed that. They usually kind of just give a couple hundred here, a couple hundred there, just to help people out. Um, but if you do decide to go crazy one year, just kind of keep that in mind. It's limited to 10%. So I mean, if you, let's say your taxable income, let's just say, is $100,000, well, you can't give more than $10,000. If you do, it's fine, of course, but it'll have to be carried forward over the next 5 years. So just you want to make sure that it's done efficiently. And a lot of this is I would say probably the taxable income. This is probably only true for like C corporations, and a C corporation is a big corporation. So most of you small business owners, you're either an S corporation, partnership, sole proprietor, LLC, or just a disregarded entity. You don't need to worry about that because everything flows to your personal. But if by chance you are a C corporation, just there's something called double taxation. So you pay from the business side, but you also pay from the personal side. I'm sure a lot of y'all have heard the term flow through. So this is not a flow through. This is just for C corporations, or even if your bookkeeper, accountant, tax preparer, CPA, whatever, just classified you incorrectly, or if by chance you are a C corporation, you're going to pay that. Just kind of remember that the 10%. And even so, when you're a disregarded entity or any business entity, IRS rules are that you can only deduct 60% of that charitable donation. So let's just say, for example, you donate $10. So you can only deduct $6, or $100. You can only deduct $60. And that's the IRS rules. It's not me doing it. So you want to obviously give it efficiently. And if it means transferring it from the business to the personal to kind of get that deduction, do it. Another avenue is that a lot of businesses, sometimes they'll donate food. Like, let's just say, they're a restaurant and they have unused cans of soup, right? And they give it. So when you give it to a charitable organization, a 501c3, is that you deduct the fair market value of the food. So let's just say that the canned goods are $1 each, right? And you donate 100 cans, that's $100 you can get as far as the deduction, whatever the fair market value of that food is. So just kind of remember those two things. Small business owners, it's good to be efficient doing that. Also, another avenue is that some of you may or may not have, you have the C corporation, which pays from the personal, and then you have the other ones, the S corp, partnership, sole proprietor, disregarded entity. You pay from your personal. even paying from your personal, it may not be the best thing. The reason I say that is because there's something called a standard deduction. And if you don't meet that standard deduction, basically that donation you give, it's, so like I said, it's certainly a good thing to give it, but it's just a matter of how you give it. But if you give it from your personal and you don't get above that standard deduction, you don't get the discounted taxes from your personal. So it's different every year, obviously. But if you don't meet that minimum deduction, let's just say you give just $100. Well, either the IRS says you can do the standard deduction or you can itemize. And itemize is basically you get all these expenses as far as your medical expenses, as far as your the interest that you pay on loans, the charitable contributions, et cetera, and you add them all together. And if the IRS says, okay, you with being married, filing jointly versus all these donations, they say, okay, this deduction is greater, so they just say, hey, this is not deductible. Or sometimes it's the opposite. You may get the itemized deduction as far as adding those expenses together versus the flat rate that you get. It may be greater, which of course the IRS says you can take one or the other. You can't take both. So if it's itemized, they say, okay, this goes away, you take that, or vice versa. So just kind of keep that in mind. Like I said, charitable donations is a good thing. It's just a matter of how you give it, because you want to maximize your efficiency. It's always a good thing to get the maximum deduction. Just a little bit about me. Myself and my partner, we have a bookkeeping business, over 15 years of experience. Right there, metroacc.com. We are Metro Bookkeeping Solutions. Check us out. Find out a little more about us. Otherwise, like and subscribe, and I'll see you next time.